In Chapter 7, titled Accounting Shenanigans, Warren Buffett critiques questionable accounting practices that can distort a company's true financial state. Buffett believes transparency and accuracy are essential in financial reporting as they allow shareholders and investors to make informed decisions. However, some companies engage in practices that obfuscate reality, inflating their performance or hiding potential liabilities. By examining these shenanigans, Buffett aims to shed light on common accounting tricks, equipping investors with the knowledge to look beyond the surface numbers. The chapter is broken down into 6 main sections: a satire on accounting, shenanigans, standard setting, stock options, restructuring charges, pension estimates and realization events. A satire on accounting shenanigans. Buffett opens the chapter with a satire on accounting shenanigans, using humor to underscore the absurdity of some accounting practices. He critiques how companies, often with the help of their accountants, manipulate earnings and balance sheets to portray themselves in a better light. In this section, Buffett suggests that investors need to be vigilant, as companies sometimes use creative accounting to mask poor performance or inflate their achievements. Through this satirical take, he emphasizes that these tactics may lead to temporary gains in stock prices but ultimately harm shareholders and investors by presenting an inaccurate view of the company's financial health. Buffett's lighthearted tone here serves to make a serious point. Creative accounting can be detrimental to transparency and shareholder trust. Standard setting. The second section dives into the role of standard-setting organizations like the Financial Accounting Standards Board, or FASB. Buffett discusses how these organizations establish guidelines to ensure uniformity in financial reporting. However, he notes that even with these standards, companies often find loopholes to exploit for their benefit. Buffett argues that while the intent behind standard setting is to provide consistency, these rules sometimes fail to address the complexity of real-world transactions. Consequently, companies can adhere to the letter of the rules while violating their spirit. For instance, they might classify expenses in ways that minimize their impact on reported profits. Buffett's point is that standard-setting bodies need to be vigilant and proactive in closing loopholes to prevent companies from engaging in manipulative accounting practices. Stock options. Stock options are a frequent topic in Buffett's discussions about accounting integrity. He contends that stock options, which are often granted to executives as part of their compensation, represent a real cost to shareholders and should be expensed on income statements. Many companies, however, avoid expensing stock options, arguing that they are a non-cash expense. Buffett refutes this claim, pointing out that stock options dilute shareholder value and should therefore be recognized as an expense. By not expensing stock options, companies create an inflated picture of their earnings, misleading shareholders about the true cost of executive compensation. Buffett's stance on stock options aligns with his broader philosophy of full and fair disclosure. He advocates for practices that provide a clear view of a company's financial situation, believing that stock options should be accounted for honestly to maintain shareholder trust and transparency. Restructuring charges are another area where companies often play with accounting rules to their advantage. These charges typically involve costs associated with layoffs, asset write-downs, or other major changes to a company's operations. While restructuring can genuinely be necessary, some companies misuse these charges as a way to clean up their balance sheets and artificially boost future earnings. Buffett explains that companies sometimes take large restructuring charges in one period to inflate their earnings in subsequent periods. By taking a big one-time charge, they create a kitchen sink effect, lumping multiple expenses into a single period to make future results appear more favorable. This approach, according to Buffett, is misleading and can harm shareholder interests as it distorts the true financial performance of the company over time. Pension estimates are another tool that can be used to manipulate financial statements. Companies with pension obligations must estimate the amount of money they will need to pay retirees in the future. This estimate depends on assumptions about factors like investment returns, employee lifespan, and inflation. Buffett points out that companies can manipulate these estimates to make their financial health appear better than it is. By assuming overly optimistic rates of return on pension assets, companies can reduce the reported liability on their balance sheets. This manipulation not only misleads investors about the company's financial obligations, but can also lead to a pension shortfall in the future. For Buffett, accurate pension estimates are critical for maintaining financial transparency. He advises investors to scrutinize pension assumptions carefully, as they can have a significant impact on a company's reported earnings and liabilities. In the final section of the chapter, Buffett discusses realization events, or specific moments when a company realizes gains or losses on its assets. Companies sometimes delay or accelerate realization events to manipulate their earnings, timing them strategically to boost financial results. For instance, a company might sell off profitable assets at a specific time to boost earnings in a weak quarter, or delay recognizing losses until a more favorable period. Buffett argues that this practice misrepresents the company's actual performance and can lead to volatile, unpredictable financial results. He advocates for a more conservative approach to realization events, suggesting that companies should recognize gains and losses as they occur rather than trying to time them for financial gain. A satire on accounting shenanigans. Buffett humorously critiques companies' use of creative accounting to inflate their financial results. He warns investors to be wary of such practices, as they can obscure a company's true performance. Standard setting. Buffett discusses the importance of accounting standards in maintaining consistency, while also pointing out the potential for companies to exploit loopholes. Stock options. Buffett argues that stock options represent a real expense and should be recorded as such. By failing to expense stock options, companies mislead shareholders about their profitability. Restructuring charges. Buffett warns against the misuse of restructuring charges, which some companies use to artificially boost future earnings by taking large one-time charges in the present. Pension estimates. Buffett emphasizes the importance of realistic pension assumptions, as overly optimistic estimates can distort a company's financial statements and mislead investors. Realization events. Buffett critiques the practice of timing realization events to manipulate earnings, advocating for more conservative and transparent reporting. Chapter 7 of the Essays of Warren Buffett. Lessons for Corporate America serves as a warning to investors about the various ways companies can manipulate financial statements. Through a blend of satire, critique, and practical advice, Buffett highlights how accounting shenanigans can distort a company's true economic value and mislead shareholders. His emphasis on transparency and integrity in accounting reflects his commitment to shareholder interests and his belief in honest financial reporting. For Buffett, responsible accounting practices are crucial to building long-term shareholder value. He encourages investors to look beyond superficial metrics and to understand the underlying economic realities of the businesses they invest in. By being aware of common accounting tricks like stock option manipulation, restructuring charges, and unrealistic pension estimates, investors can make better informed decisions and protect themselves from potential financial misrepresentation. In essence, Buffett's guidance in this chapter is a call for greater accountability and transparency in financial reporting. His insights remind investors that while accounting rules provide a framework for financial reporting, true integrity comes from adhering to the spirit of these rules, not just the letter. Through this chapter, Buffett reinforces the importance of ethical accounting practices as a foundation for long-term corporate success and shareholder trust.
Thank you for watching. Share this with friends and family, and please subscribe.